So we're coming up to the end of financial year in Australia, and we're about to welcome in July. Yes, half the year is gone already. Now, if you're involved in the innovation ecosystem, you're probably thinking to yourself, why is there so much noise at the moment? Why is there so much activity going on? There seems to be more events than there was sort of over the last couple of months. It feels like everything's busy. There's a lot of messaging coming out, etc. Well, that sort of goes to communicate to the sort of natural timing and rhythm of capital raising in Australia. This video is really, I suppose, both a guide for both founders and investors in how to understand this rhythm and also in how to approach it. Now, at the end of this video, I'm going to be talking about when all the rules that I'm about to go through are completely out the window. So firstly, why the current buzz of activity right now? Well, there's two factors at play. Firstly, it's the end of financial year. The end of financial year is a natural time where deal makers and also companies looking to raise capital are looking to finalize their capital raise. Likewise, for many investors, they're also looking to place their bets or place their investments before the end of financial year. So therefore, there's been a lot of messaging go out over the last 3 months, sort of building up to this time frame. And now you're in that sort of closing season of bringing that money in, but also trying to finalize the capital raise with new investors as well. So that's the first thing that's at play. The second thing that's at play is that in Australia, we're very well aware that December and January are pretty much dead zone months when it comes to a capital raising perspective. So you've got to plan for that end of year slowdown. So if you think about the natural capital raise cycle, it will often take anywhere from 3 to 6 months. So understanding that, most companies are in the process of launching their capital raises right now, or even going through the preparation phases, because they know that they need to start engaging with investors now and reaching out and having conversations and presenting at events and doing all the things that they need to do, because they're looking to raise capital before November 30th. Right? As I said, you've got those two factors at play. You've got the end of financial year. We've got a lot of companies trying to finalize deals from all the work they've done over the last few months. And then also you've got companies that are now kicking off their capital raising with the outcome that they want to finish it by the end of November 30th. So this is why this is such a busy period right now. So to help you understand the Australian fundraising calendar, there's a few things you really need to think about. So effectively, June to August is effectively the end of financial year rush and also the start of new fundraising cycles as well. Then you've got August to November, which is really the prime time to be building momentum, building engagement with investors, etc. For us as a company, we've got events on July 29th and August 21. And we specifically time it in that period because we want people to have their introduction in the first half of the second half, and then effectively be having the conversations down the track, because December to January is obviously the dead zone, right? December, January is a dead zone for deal making, but it's fantastic for visibility and engagement with future upcoming strategic and corporate initiatives that you may be doing. So we find that video content is fantastic at that December to January time. And then February to March, that's the rush. So it is incredible. Each year, there's an incredible amount of companies that are kicking off their capital raises in February and March. And we typically host our emergence conference in that period. So now you sort of know a little bit of the secret about when we do our timing of our largest events. So timing does really matter for companies, and it also does matter for investors as well. So it's best for you to work with these natural engagement cycles from both the founder side and also the investor side. Too often I hear founders say, oh, we're going to look to start our capital raise in October. Well, that makes no sense whatsoever, because effectively you're going to be starting your capital raise in October. You're going to get whatever momentum you can build in October and November, and then all of a sudden you're going to be hitting December and January, and you're going to lose that momentum. And then effectively you have to work hard to then gain that visibility, gain that momentum back in February and March. And there's one thing that we all know when it comes into deal making is there's two big killers when it comes to deals. Number one is time, and number two is lawyers. Don't tell the lawyers about that second component. As a famous joke that someone once told to me, but the time issue is a big one. So if you are thinking about raising capital, effectively you're either going to be starting it now or you're going to be starting it February next year. You've got to start making those moves right now if you're planning on raising it the next sort of 3 to 6 months. So as I said, it's illogical when people say to me, oh, I'm thinking about kicking off my raise in October. That doesn't make sense whatsoever. even September, because effectively you could start to get momentum across a 2 to 3 month period, and understanding that now capital raising cycles are taking longer than what they did, 2 to 3 years ago. You got to plan for that, right? So if you want to raise capital in the second half of this year, now is your time to be super active, or you got to start planning the visibility campaign effectively to start building awareness and so forth, and then prepare to launch your raise in February. Our strongest encouragement for companies when they're thinking about their capital raise, it's best to build awareness and engagement well before you actually launch your capital raise. So to summarize, if you're a founder that's raising capital, there's 2 optimal times to be starting the process of building awareness, building engagement, building relationships, etc. That's going to be from June to September, right? Because you're going to be engaging with investors who are active post the end of financial year. And also you're going to be looking to gain traction in that process, and you want to close it before the end of year slowdown. The other time period is from February to April, where effectively, people are typically coming back refreshed after holidays. They've sort of mentally taken December and January off, and now they're looking to get super active, right? And they have a clear run rate till the middle of the year. So you're effectively starting February to April, and then you're looking to finalize in actually the end of June. Now, some of the perils of poor timing is that effectively, as I mentioned, you can lose momentum, right? You can need to create extended runway requirements, and that's where sort of bridging rounds comes in, and all that sort of stuff. And also there's missed opportunities. I always say to people that the benefits of always be raising, not that you're always taking money into the company, but always having engagements with investors, is that there could be opportunities that you could take advantage of, that if you're not ready to raise, or if you're not ready to go into that process, that you could actually miss out on. So from the investor's perspective, I would just say that, you may not have sort of thought about this consciously, but effectively deal flow management, expect that that's typically going to be the 2 of the busier times for you to start becoming aware of new deals, and then you've got a period of engagement sort of following. This is the time to be attending conferences, attending pitch events, etc., and be super active. Of course, you're going to be being emailed deals sort of throughout the year, but it's more about sort of that concentration of attention, and then sort of strategically planning your sort of activities around that sort of fundraising cycle. Except you naturally see this takes place, but effectively, if you can actually plan for it, you can be a lot more efficient and effective. Now, the final part of this video, when should you go against this advice? When you should go against this advice is when your sector is hot. If your sector and your spot, your area is hot right now, you need to run, you need to sprint, you need to do absolutely everything possible to take advantage of it. For example, every crypto company should be absolutely out there engaging with investors and looking to raise capital, right? Any company that's effectively, all the credit related opportunities should be out there looking to raise capital right now, because that's got everyone's attention. Every company in the area of energy transition and sustainability should be super active in the capital raising mode. Now, does that mean that if your sector is not hot that you shouldn't be raised? Of course not. Just look to work with those timing cycles that I was talking about beforehand for your sort of maximum effectiveness. The reason why you've got to go when your sector is hot and you've got to sprint, and do not worry about timing, do not worry about any of that, is because there is only one time that you will get the opportunity to raise capital when your sector is hot and you feel like the absolute wind is at your back and everything is easy at that point. And trust me, that spotlight doesn't last long. The reality is most companies only get this once in a business life cycle, right? Twice if they're lucky. For the crypto companies, they get it every sort of 4 years, right? They've sort of got it programmed into the code. But for many other companies, said the energy transition guys, run with it, right? Think about this. 2 years ago, everyone was talking about ESG. Now it's not talked about. It's been rebranded to impact, right? So just understand that when your area is red hot, you need to run with it. And effectively, because it said that is when you're going to have the most opportunity to have people looking to engage with you, understand you, etc., and learn more about your business. Likewise, valuations are often improved when your sector is hot, etc. So that's my sort of guidance. And I tell you, one of the hard things for me is I get frustrated around, I know that a sector is red hot and people are just like, I'm going to wait. I'm going to play the patient game. We're going to take our time. You only get it once. That's the truth. You only get your hype cycle once typically in the life of a business, and twice if you're lucky. So you need to absolutely run. So, I hope that's really helpful to understand why there's so much buzz and activity right now around the sort of capital raising area, why there's sort of increased amounts of events, increased amounts of communications and activities, is because it's just, effectively us working with the natural cycle of capital raises and timing the way it actually plays out in Australia. If you like this video, hit like and subscribe for more.